Let's say record.
I'll record.
All right, so we continue now with our second lecture, and second lecture is overview. And I already covered a good chunk of our bond overview. The first is called the indenture. So, you now zoom in, right? Bond. Indenture. You keep for about 5 seconds, right? So people can take a note. And now you zoom out completely. So, what is the indenture? The indenture is the contract or the agreement between the borrower and the lender. So this is the legal contract, the legal agreement between the borrower and the lender is called the indenture. That's it. Let's see what else we have. The first one I already covered. Maturity. The life of security when it's going to be paid in full. Sometimes it's called term to maturity. So you can have term to maturity, 5 years. Next concept is short term. And so you're zooming out, right? And short term simply means within less than 1 year. So 1 year or less. Intermediate term. And here intermediate terms got a lot of different definitions. One of them is between 5 and 12 years. So 5 and 12 years. Let's see what the textbook is giving us. Yes, it's giving us 5 and 12 years. So this is less than 1. This is between 5 and 12 years. Well, are you zooming out or zooming in?
In.
Huh?
In.
Okay. Long term is 12 plus. All right, what's the question? If you have a question, you gotta ask me. Well, I mean, okay? This is university, okay? It's not high school. All right, so, or if you have any business, just take care outside. When it's done, come back in here. All right. Next is a very simple and elementary concept of volatility. And volatility simply means price fluctuation. How much the price varies. How much. You zooming out completely?
Yeah.
Okay, zoom on. So, volatility basically means, does the price vary little or the price varies a lot? Think of the price of oil. If the price of oil goes 78, 79, 78, 79, 78, 79, and it just varies $1 up, $1 down, that's nothing, no big deal. We call it little, small volatility. Now, it could be jumping $80, $120, $80, $120. So, volatility could be just tiny little, meaning very small fluctuation, or it could be a huge fluctuation. So basically volatility gives you the overall up and down movement, and the volatility is in modern finance the correct measure for risk. So, in modern finance, risk is measured by the volatility. If the price is moving a lot, we say that the asset is very risky. If the price is relatively stable, we say that it has a relatively low risk. Or the price may be perfectly constant. And if it's perfectly constant, then it does not have any risk at all. Okay, so risk in modern finance is measured by the volatility of the asset. And this type of risk is called price risk. Okay? You zoomed out completely, right? Are you? Okay, let's see what's next. So, volatility. Okay. So, what has this long-term, short-term have to do with volatility? And the answer is very simple. For a bond, higher maturity means higher volatility, and higher volatility will mean higher risk. So, 2-year bond is typically going to be riskier than 1-year bond. A 10-year bond will have a higher volatility than a 1-year bond, okay? And will have a higher risk. So you have the most basic relationship in bonds and in bond markets, which is part of general finance, that the higher the maturity, the higher the risk. So longer term bonds are riskier. That's it. That's the basic relationship. That's why those investors that are relatively risk averse will be choosing shorter term maturities, and those that are willing to accept higher risk will be taking longer maturities. So here's the first thing to understand. Bonds are not necessarily riskless. They have their risk, and I'll be discussing all sorts of risks probably in the next 20 minutes. All right, so let's see what else we have. Okay, the next I already covered last lecture is principal or principal value. We did that. It's also called redemption value. And redemption value is exactly the same as principal, which I already told you from last lecture was face value. And another name for it is called par value. Sometimes we just call it par, okay? So par is the same as face or face value, or par value is the same as redemption value, is the same as principal. Sometimes they even call it principal value, okay? So you can use the word value or you don't have to use the word value. And we also have nominal. It's also called nominal value. So this is the same as principal, is the same as redemption, is the same as face, as par, as nominal. And sometimes people are confused because they have 5 or 6 words for the same thing, okay? It's just very confusing. Then you have coupon. Now, some people pronounce it as coupon, and it's okay, but most of my professors would usually pronounce it as coupons, with U, coupon. And coupon is the payment. Coupon for a bond is the payment of interest. Okay? And sometimes you call it coupon payment. Okay? And you also have, let's take a look, you also have a coupon rate. coupon rate. And the coupon rate is presented in percentages. 3%, 5%, 7%. And the coupon is equal to the coupon rate, which is the percentage of the face value. So a 5% coupon rate will equal to a 5% of 1,000, face value is usually 1,000, is equal to 50. So 50, okay? So coupon rate 5% equals a coupon payment of $50 or 50 of the currency. All right, is that fair too? Okay, let's see what's next. Sometimes we call it installments. Installment in finance means a regular payment. Usually installment means a regular payment of the same amount. For example, when I owned a house in the United States, my monthly installment for my mortgage was $800 US. So every month you pay $800, $800, $800, $800, okay? We call this installment. So you may have what's called annual coupon or annual installments. Okay? This means that coupon is paid every year. Okay? The two of you guys, why don't you just separate? Because it just separates. Okay? That's one of your comes up front here. Focuses on me, not on, your buddy over there. All right? So, you have annual coupon, you have semi-annual, sometimes pronounced as semi-annual. Semi-annual. And annual and semi-annual is what I explained from last time, is the same periodic. Periodic means at equal intervals of time. Okay, that's periodic. Periodic means equal period. Now, if you can't see, you just move up front. Okay, if you can't see there, just move on the first or the second rather than like trying to. Okay, so periodic means equal interval of time. So periodic for annual means every year. Periodic for semi-annual means every 6 months. Okay, it is rare but possible to have quarterly, meaning every 3 months. Okay, let's see what's next. Coupon is so, okay, you may have a zero coupon bond. Okay, so the broad division is between what we call coupon bond and zero coupon bond. Coupon bond is a bond which pays a coupon, everything that I've been explaining so far. Okay, that's a coupon bond. Zero coupon bond is a bond which pays no coupon. Or technically, legally, the coupon's rate is zero. And if the rate is zero, then the payment is zero. And if the payment is zero, we simply say that there is no payment. Okay? So a zero coupon bond pays only the face value on the maturity date and pays nothing in between. Okay? And a zero coupon bond is the financial equivalent of what you should have studied before. It's called simple loan. And simple loan is just a loan, usually a bank loan, or could be any other loan by finance company or anyone else, is simply a loan that's going to be repaid with one single payment. For example, this could be my dad and say, hey, can I borrow $1,000 and I'll pay you back on the first when I get my salary, okay? That's a simple loan. So I'm not going to be paying. So simple loan means repaid with one single payment. Well, in terms of bonds, the equivalent is a zero coupon bond. Now, what's the difference between a simple loan and a bond? Well, the bond is actually a security. And the bond will actually be traded on a bond market. So the bond will actually have a price and it will have a liquidity. Liquidity for an asset, whether it's a house, stock, bond, gold, watch, jewelry, for any kind of asset, liquidity simply means the ability to sell quickly with a little or no loss. Houses are not liquid. You try to sell your house very quickly, you can't, okay? It's not very liquid. Try to sell my watch now, 300 US dollars, that's the price. Is anyone going to buy it for 200? Probably not, right? Anyone going to buy it for 100? No? You guys don't want to get a $300 watch for 100? No? Nobody? Wow. Anyone going to take it for $10? It's a quality Seiko-kinetic, right? No? So I can sell 90% loss and I still can't sell it. Is that how bad it is? Huh? Is that how bad it is? No, it's actually top quality watch. It's got sapphire glass, it's gold plated, it gives you less than 1 second. Phenomenal watch, but it's got only one little problem. It's illiquid, does not have liquidity. It's difficult to sell, okay? Well, I discovered that, let's say, your own Taiwan dollar, is it liquid or not liquid? Oh, perfectly liquid. I can immediately sell it for tea, for lunch, for coffee, for US dollars, for anything I want to sell it, I can sell it almost instantly. All right? And if someone's got US dollars, I can quickly exchange it for US dollars or Japanese yen or something else. Okay? So, currency is actually one way to define money. The correct definition is the asset with the best liquidity in the market. So the most liquid asset in the market is called money. That's the correct and proper definition. And bonds usually are very liquid, means investors like bonds because they get guaranteed payment of coupon, guaranteed payment of interest, and it's at the same time liquid. Whenever you need it, you can easily sell it, okay? At least sell it for the market price, okay? That's called liquidity. So, where was I? Coupon, semi-zero coupon, okay? Okay, yeah, you have floating rate. Okay, so bonds are effectively of two types: fixed rate and floating rate. Fixed rate means that the coupon is fixed and never changes. If it's 4%, it's 4%. It's 4% at issuing, until maturity it is always 4. Floating rate is also sometimes known as adjustable rate. So floating rate is the same as adjustable. Means that every 6 months, or every year, or every 2 years, usually on an annual basis. Every year, the interest is adjusted according to some formula. Usually you have an international benchmark like LIBOR, and you're going to have some premium. I'll be discussing those in a lot more detail. But all you have to understand is you've got fixed rate bonds where the coupon rate is fixed, and variable, oh yeah, let's write this, variable rates. So you got adjustable rate and you got variable rate, and it is all the same concept. So every year you will adjust it. Now here's what's important to understand. In these bonds, you don't know what's going to be the coupon. You don't know how much you're going to get paid. But you know the formula. For example, it's going to be LIBOR plus 2%. If it's for euro, it's going to be Euribor plus 2%. So it is very misleading that they say fixed income. Come on, guys. You got to be independent. That's why we record it. If something's not clear, you ask me. That's my job.
Is that adjustable?
Yes, adjustable. Yes. So it's floating rate is the same as adjustable, is same as variable rate. Again, guys, it's a amazingly simple principle. If you have a question, you never ask your classmate. You ask me. That's my job. That's what I do. That's why I fly from the other side of the world, from 15,000 kilometers, and that's why you're paying good money to this university. If you have a good question, meaning in finance, investments, economics, that you ask, and I will answer. That's what I do. I don't do anything else. If you didn't understand something, I will explain it to you, okay? And that's my job. I don't have anything else to do, okay? I'm staying here 24 hours a day, 7 days a week, so that for these 3 hours, if you have a question, whatever it is, I'll explain it, okay? I don't have anything else to do, okay? All right, so back to these. So this is based on a formula, which I'll be explaining again. Again, I'm just trying to give you an overview, and that's what chapter 1 is doing. And over the coming 4 months, I'll be giving you a lot of details, and you're going to be getting them from the textbook. All right, let's pause here. Any questions? You have any questions so far? Is everything fairly clear? Any questions? Everything good? Okay. All right, let's see what else. We continue. So nominal face coupon. Oh, okay. Formula. Okay, formula is okay. And the formula is the following. You always have, it's called reference rates. Reference rate. So I'm continuing actually the discussion of floating or adjustable or variable rate. All bonds have a reference rate, and this is usually LIBOR or some other widely recognized international benchmark. Okay, so that's the one, and then you have what's called margin plus. Margin, and sometimes this margin they call quoted margin. So sometimes it's known as margin, someone as quoted margin. Okay, and a simple example, the most popular interest rate in the world is LIBOR, and sometimes LIBOR is pronounced as LIBOR. Okay, London Interbank Offered Rate. So this is the interest that banks charge each other, kind of like, okay? High quality banks, and they're going to say plus 2% quoted margin. Could be 3%, could be 4%, could be 1%. I'm just giving you an example, okay? So basically, they're just going to be some standard, we call it reference. Yeah, reference rate is also known, and I've always known it as benchmark. Benchmark rate. So the most common benchmark is LIBOR, and I said pronounced also as LIBOR. Okay. So benchmark plus margin or markup. Okay. And that's how they work. Let's see what else we have. Inverse floating rate bonds. Oh man, that's complicated. Inverse floater. So, inverse floater is also known as inverse floating rate bond. Let me try to provide for you simple, easy, and relatively straightforward explanation so that you can actually understand it in a simple way. It's fairly complex, the whole design and everything, but it's very simple. When interest rate goes up, the security pays less. When interest rate goes down, the security pays more. So I'll give you the simplest example will be that coupon rate will be 6% minus LIBOR. 6% minus LIBOR means if LIBOR is 1%, this is going to be paying 5. If LIBOR goes to 2, this is going to be paying 4. If LIBOR goes to 3, this is going to be paying 3. And if LIBOR reaches 6, this is going to be paying 0. Okay? So some people may want to invest when interest rates go up, they're going to be getting less. And when interest rates go down, they're going to be getting more. Okay? You may do this for hedging purposes. To hedge means to lower the risk. You zoom in out or not zoom in? You gotta, is it zoomed out?
Zoom in.
Huh? No, gotta zoom out. You keep it only 5 seconds. You don't need to keep it too much.
No, just keep on. Okay.
All right, so hedging simply means to lower the risk. Hedging means to reduce the risk. Hedging means if you have a certain amount of risk, measured as volatility, you try to somehow reduce the volatility of the portfolio. Okay? So hedging usually involves buying an asset which moves in the opposite direction so that the two volatilities cancel each other. Okay? In finance, you probably studied beta. Have you studied beta so far in finance? Means a negative beta, moving in value in the opposite direction of the primary risky asset. So some people use inverse floaters for speculation, betting that interest rates will go in a direction, let's say down, and they're going to be profiting from them. Others use it as hedging, okay, purposes. Now, let's see what else we have. Reference, okay.
Excuse me.
Yeah, question?
Explain
Hmm?
benchmark rate.
Benchmark.
Right.
Benchmark is exactly the same as reference. This is interest rate, which is used in the formula to calculate the floating rate. So it is internationally recognized interest rate, which everybody knows, okay? When you open any financial website, you can always see what's LIBOR, okay? So LIBOR is one example of a benchmark rate, okay? You can get other benchmark, but this is the interest rate which you use in the formula to calculate the floating rate, okay? Is that fairly clear? All right, let's see what else we have. Okay. I already covered last time. You have high yield bonds. And high yield bonds, as the name says, gives you high yield. Okay? So, yield is associated with a return on asset. So you may have a yield for real estate, okay? You may have a yield for bonds, you may have a yield for stock. And the yield is simply the income that you get divided by the price. So yield is practically the same as return. So high yield bonds are bonds that provide high yield. Okay, but yield means return. And the question in finance is, how can you get higher return? And the answer is, the only way that you can get higher return is by getting higher risk. Okay? So, the only way to get a high yield is to get high risk. This relationship where higher risk means higher return and higher return means higher risk is well known in finance as silence, as capital asset pricing model. You studied it, right? Capital asset pricing model says that higher risk requires higher return, and the only way to get higher return is through higher risk. That's why you got the arrows in both directions. You can't get higher return unless you increase the risk. Okay? It's that simple. So, basically, high yield bonds is the same as high risk bonds. And high yield bonds is, back to what I was explaining a few minutes ago, is the same as junk. Bonds. Okay? And again, people understand intuitively junk bonds are usually junk, garbage. They usually are very high risk. So a high yield bond is a misnomer. It intends to mislead the investor, especially the unsophisticated investors. Like, do you want a 3% bond or you want a high yield bond of 9%? And the unsophisticated investor, oh yeah, I want 9%, not 3. No, give me the 9%. But they usually don't explain to you that the 9% bond has so much higher risk. It's a junk bond, okay? But that's how you sell junk bonds to retail unsophisticated investors, by giving them a nice fancy name. All right, let's see what next. So where are these used? These are used in LBO. What is an LBO? It's a leveraged buyout. So when some outsiders want to take over the company, what they do is they borrow, they take a loan. It's called a leveraged loan. They take a leveraged loan and they use the loan, they use the debt to buy the equity. Okay, they use the debt to buy the equity. So what they usually do is they usually issue junk bonds. You zoom it out completely?
Mm-hmm.
Yeah? Okay. So they issue, this leveraged loan is usually financed with junk bonds. So they issue junk bonds. Okay. So here's now the next concept. The next concept to understand is that leveraged loan is in this particular case of an LBO, it's called leveraged buyout, is associated with leverage. Okay? And leverage in finance means simply debt. And one of the most basic relationships which is studied in corporate finance is that higher leverage means higher risk. So leverage effectively implies risk. And that's why LBOs, which are leveraged, means they allow very little equity, they use an awful lot of debt and therefore very high leverage, and therefore they usually provide high risk and high yield. Okay? So that's for LBOs. And you also have what's called deferred coupon bonds. Deferred coupon bonds. So, a deferred coupon bonds means that the borrower does not actually pay the coupon in cash. Let's see what we got here. So, instead of paying in cash, they use something else. One of the techniques is, instead of paying in cash, they give you another bond. Okay? So, for example, you have 1,000 bond, you got a 5% coupon, but the 5% coupon equals to coupon rate equals to $50 coupon. Instead of giving $50 cash, they give you a new bond of $50. Okay? So essentially they're avoiding paying back with cash. They pay back with promises. In other words, they don't pay back yet. So this could be used for tax purposes. It's sometimes used for speculative purposes. It's oftentimes used simply to fool bond investors. Many bond investors aren't exactly very sophisticated, even though on Wall Street they'll tell you the most sophisticated investors are always the bond investors. There's plenty of suckers out there that you can fool and cheat or mislead them. Okay, that happens a lot. All right, so bonds will have what's called, well, let's write here, amortization. So I'm going to move the camera, right? Amortization. And to amortize basically means to pay down a financial asset. So amortization essentially means paying down the debt. Now, let's see where we have. Amortization, to amortize becomes amortization schedule. And amortization schedule simply tells you how the payments follow. It basically gives you a date and a payment. Okay? And usually the amortization schedule will tell you whenever you make a payment of, let's say, 1,000, it will tell you how much of it is interest payment and how much of it is principal. So usually amortization schedule will always tell you what's the full payment and will break it, the date, and break it down into interest and principal. Okay? and you know the full amount of the debt, and for each payment you subtract the principal, okay? And covering and paying down the principal is simply called amortization. All right, let's see what else we have here. Amortization. Yeah, and these are called amortizing securities. Typically, let's use the opposite arrow. Let's use the opposite arrow. Amortizing securities are created from loans. And as the loan is paid down, you pay down the security itself. Okay? The most common amortizing security is the mortgage bond, which is created out of mortgage loans. So let's write out. You have mortgage loans. You take a whole bunch of mortgage loans, 100 of them, or 1,000, or 10,000. You pull them all together, and the arrow is in the opposite direction, backward, and you use to pull them all together to create a mortgage bond. The process is called, as I explained last time, securitization. And the mortgage bond is an amortizing security because it is usually the loan is paid down in what I explained over there in installments. So when you have here equal installments and the borrowers pay down in equal installments and you pool these loans together, you create an amortizing security. The other type is called non-amortizing security. Non-amortizing security. All right. We got a few more things to finish for today. We've got about 10 more minutes, right? Is that right? About 10 minutes? No. Here, to finish class. Right? Okay, we got one page. Okay, we have what's called embedded options. That's on page 5. Okay. So, an embedded option is basically provides the right either to the issuer or to the lender to do something. So, options usually are in the type of call options and put option. And I'll explain now the so-called call provision. Call provision basically means that the issuer has the right at any point in time to call in the bond. To call in the bond basically means to pay back the bond. So you got a 10-year bond which pays 7%. It's a very good interest. It's a very high interest. Over the next 3 years, interest rates fall down to 5, 6, 4, and 3. Right now we're at 3%. And the borrower, the issuer, said, oh, I can issue a new bond for 3% and pay back the old bond of 7%. Okay. Well, this is called refinancing. To refinance means to take a new loan to pay back an old one. That's refinancing. So for bonds means you issue a new bond to pay back the old one. Well, in a call provision, this means you can issue a new bond which is earlier and sooner before maturity. So even though it matures after 5 years, you issue a new bond now, you pay 3%, and you retire the old bond that was paying 7%. And you save yourself the 4%. Well, the key question is, can you pay back the bond early? And that's what the call provision is. Call provision allows the issuer to pay back the bond early, to pay back the bond before it matures. Usually because it can find cheaper way to refinance itself, okay? Is that fairly clear? No? It's just, you're tired already? Well, why is everyone like drunk? What's going on? All right, we're done for today. No need. Let's go home.